Well, inflation or fear of inflation was what caused the sell-off. Let's talk more about it. Bring in Steve Liesman, the man who can answer the question. Do you think, Steve, that the Fed is increasingly feeling boxed in, that it needs to start changing the language that it uses with the markets when it comes to inflation and its time frame for raising rates?
I think the Fed is making a very bold call here on the economy and on inflation and how things are going to work. And knowing the way I think that central bankers think, I'm sure there's some doubt about that. But everything I hear, Melissa, suggests to me that they are not about to change their general idea, which is that this inflation is going to pass through the economy and that the key metric to figure out when and if it's time to change policy is more linked to the jobs numbers and the overall growth and the recovery of the economy from the pandemic than it is to these inflation numbers that it sees as temporary.
You know, Steve, I thought I knew what the word transitory means, but I'm not sure that I do in the way that the Fed uses it. So this is what got me thinking about what is transitory. I saw a tweet this morning from Northman Trader, otherwise known as Sven to us, but he tweeted this picture of an asteroid or maybe a meteor on fire coming down to Earth with dinosaurs roaming the land, saying, is this a transitory event? Meaning, yes, the meteor just flashed right by. It took like 1 second, but it also scorched the Earth and created, an extinct species. So what is transitory in the Fed's view?
Well, let me first quote Art Cashin, Melissa, who said once, the end of the world happens only once. Is to trade you have to time very carefully. So I would just say that to your meteor metaphor, so to speak. Look, can I show you transitory?
Yes,
can you
please.
guys put up that airline prices chart that I have? And you guys chew on this a little bit. I have a couple things to say about this. This is the index of airline fares. At its worst, they were down 30%. They've now come back to being down now about 16% from their high in February 2020. You can see there that jump that you just had up on the screen of 10% in the past month. We are still down from where we were February 2020. Now, if you wouldn't mind, this was uncalled for ahead of time, but if you could put up JETS, which is the airline ETF. You guys did not buy airline ETFs, which are up by my estimation 107% in the past year, without thinking that airline prices would come back. So I guess I'm answering your question, Melissa. This is the meteor you expected to happen. I think a better metaphor is this, okay? Which is that, you know how you go to a gun range, and I'm thinking like Guy Adami and maybe Tim Seymour have done this before, and somebody says, I'm about to fire this weapon, there's gonna be a really loud noise, don't freak out. Well, guess what happened today? The gun went off. You had a big inflation print because things like airlines came back, lodging away from home, which is still down from where it was, that came back. You heard a big boom, and now you're freaked out. But guess what? A lot of the pricing in stocks was for this exact thing to happen. If you want to get back to where we were for the recovery, you've got to have a recovery of prices. So I'm not saying inflation is not something to worry about, something to put on your area of concern. I'm saying the freak out today, if it was about inflation, is perhaps a bit overdone.
So, Steve, using your weapon and quoting the Grateful Dead, who I think William Tell stretched his bow till it wouldn't stretch no more, and furthermore, until a change had to happen. And I might have slightly paraphrased the last part because that's what I think the Fed is running into. They're trying to create possibly 30 or 50 or 70 basis points of inflation at the risk of an asset bubble. Does that make sense?
It's a good question, and the quote is, William Tell us stretch his boat till it won't stretch no furthermore, and or it will require a change that hasn't come before, to be precise, Tim.
Wow.
But that
I knew you would know that. Oh, my God. Nice.
That said, yes, they're playing with fire. They're a little nervous. Guys like Rosengren are a little bit nervous. But the question is whether or not this works through. Another metaphor, it's not a very seemly metaphor. It's the anaconda digesting its meal right there. It passes through in the worst sort of way, I guess is the best way to put it. And it does risk an asset bubble. I can't tell you how to trade these crazy tech stocks. All I can tell you is that when I look, for example, at lumber futures, 50% of commodities are in backwardation. What does that mean? It means the price a year from now is below the price that you have today. And so the bet in the markets right now is that this inflation passes through. I talked to a guy in the lumber market. He said to me that the mills are just not running up to speed. I just talked to Phil LeBeau. Available seat miles are 30% below where they were in 2019. So how do you play that in terms of inflation? They bring these back, you get a little bit of pricing power in there, but does it mean continuous 10% rises in airline fares? I don't think so.
Yeah, Steve, I'm with you. I've actually been to a gun range. I went to one in Wyoming. It was pretty cool, actually. I'd never shot a gun before, but that's neither here nor there. But what I will say, and I know you know this, so I'm not breaking any news, but you know that gunshot, I mean, from the sound it makes leaving the gun to the target is transitory, but the damage it does to the target or to the watermelon or whatever it's shooting at is permanent in a lot of cases. That, I guess, that's the point. Could the damage done waiting to get through transitory be permanent or so bad that it impairs the economy for years to come?
Definitely some risk of that, Guy, and you cannot dismiss it. I don't think the Fed is dismissing it. You had comments today from Clarida who said if you get inflation, a change in inflation expectations, and by the way, that's the target they're watching. If you want to know what the Fed is thinking, watch, I think it's Friday for the University of Michigan, inflation expectations. There's a new metric out from the Fed that I just started studying today that aggregates some of the inflation expectations data. That's kind of like their inflation dashboard. That's the damage. The damage is to the broad psyche of consumers that believe tomorrow, or not just tomorrow, next year and in 3 years, prices will go higher. That's what they're worried about. But right now, the way they look at it, 3, 4, and 5 year forward inflation expectations are relatively under control. If there's real damage to that, Guy, I believe the Fed will act. And those are the things to watch to know if there is real damage.
Not to harp on this whole transitory thing, Steve, but I'm not sure I got an answer out of you.
You're going to give me the meteor again?
No, I've left the meteor by the wayside at this point. But is the implication here that we need to get back to pre-COVID levels in order, and whatever that time frame is, that's transitory? Because that means that we're going higher and we're staying there, which to me is not transitory.
No, that's right. That's probably right. That's not wrong. But that's not inflation, right? If you get back, put up that airline chart again.
So everything that happens between now and there is not inflation.
Well, it's not the second or third derivative of inflation. You get 10% increase. If you get 12% increase, then you have accelerating inflation. Right. Now, I just want to call up a spreadsheet that I made earlier today, Melissa, and I figured out, okay, so 0.7% of the increase today was simply base effects. You had a fall off of the decline from the pandemic. So what does that mean? It means that if inflation did not rise at all from March to April, you still would have had 0.7% inflation. That goes away, I'm going to tell you in a second here, beginning in July is when that starts to go and reverse the other way, when those negative base effects roll out. So you start to get a positive thing in July. And then let me just spin a scenario for you. So it means a pretty hot summer. It means we're going to be having this discussion, which I, by the way, love having, for several months to come. But if you think about schools reopening in September, some of that capacity, like airlines and lumber mills, being brought back online, unemployment benefits running out in September to bring people back to work. By the fall, we should begin to have both a more normalizing economy and hopefully prices normalizing by then. Transitory, I think I'd put September down as the end and upper limit of my tolerance for transitory.
Hey, Steve, thank you. You always have the answers. Steve Liesman.
I'll try. Thank you.
It's going to feel like a long way, though, Steve, from now until September, if this is the way the market acts whenever we get an inflation print.
You add climate change and you got the hot summer of inflation, and it's a hot summer.
All right, Liesman, thanks. Grasso, I'll go to you. Two Steves, my error.
Yeah, I'm sorry. I thought he was gone. So I think we're in that Goldilocks, as I mentioned before, with rates. And it was shocking to me that we did not tick above the 1.74% in the 10-year while it felt like Rome was burning in the equity market. I think we are in that sweet spot. I think we're going to be okay. I think the market will bounce. The S&P bounced right off the 50-day, right where it should. I think there's a lot of panic. Karen said it before, baby out with the bathwater. I think everyone is selling everything and then checking what they own at the end of the day. Stick with your reflation trades. Stick with the economy reopening. This was a man-made event that we had. We shut down our own economy. People will be getting back to work. Supply and demand will catch up with each other. I think this is a lot of panic.
Shepard Smith here. Thanks for watching CNBC on YouTube.